Welcome to Inflation and the Impact on Insurance Companies. To receive a copy of today's presentation, please send a request to replyrrc@riskreg.com. To ask a question during the meeting, type your inquiry into the Q&A panel to the right of your screen. We will respond to all questions after the session unless time permits at the end of the session. To answer polling questions, click on the radio button to the left of your desired response, then click Submit to record your response. For technical assistance, click the Help widget at the bottom of your screen. Today's presentation will be recorded. CRE eligibility. Log into the webcast with your first and last name and email address. Remain on the webcast for a minimum of 15 minutes. Participate in polling questions. 80% response required. To answer a polling question, click on the radio button to the left of your desired response, then click Submit to record your question. You do not need to have the correct answer, but must participate to receive credit. Complete the course participation survey located in the resource list to the right of your screen. For attendees participating in a group, designate one proctor to log in as an individual on behalf of the group, then complete and submit the group sign-in form within 24 hours of the event's conclusion. The form can be downloaded from the resource list on the right of your screen. Complete and submit the course participation survey. The form can be accessed from the resource list to the right of your screen. One CRE credit will be issued to eligible participants within 30 days. RRC will not issue credit if all criteria are not met without exception. It is now my pleasure to turn the call over to Dave Heppen. Dave, the floor is yours.
All right, thank you very much. And hello, everyone. It is great to see a large group of people that we seem to have who have joined us today to talk about inflation. So it's quite the hot topic, and we're looking forward to speaking about it with you. So my name's Dave Heppen. I am a P&C actuary, have about 30 years of experience in the industry, and I am a partner with RRC. I'll pass it over to Tricia to introduce herself.
Thanks, Dave. This is Tricia Matson. I'm also a partner here at RRC, and my background is that I am a life and health actuary. So I will turn it over now to Bill.
Hello, everyone. My name is Bill Michael, and I'm a director with RRC. I started my career over 23 years ago at Arthur Andersen, and then I worked at a few other accounting firms conducting various internal audit work for insurance companies. And I joined RRC in 2006, and my primary role is serving as the EIC on financial exams for various states. And I will turn things over to Ed.
Thanks, Bill. Hello, everyone. I usually like to think that everybody knows me. But for the 3 or 4 people that have joined us that don't, I started out as an investment person, an actual investment person, and as a portfolio manager for a major insurance company way too many years ago. Spent a couple of years at a hedge fund, and then 10 years with the NEIC, most of that as director of the NEIC's Capital Markets Bureau. I've been with the firm for a little over 3.5 years now, as the investment person. So I think I turn it back to you, Bill.
Yes, and we're actually going to kick things off with a polling question. So as it was noted, we'll have 5 polling questions throughout, and you must answer at least 4 of them. So here's the first one. True or false? The NAIC included inflation risk as an emerging risk in the fall 2021 Solvency Monitoring Risk Alert. So click on one of the 2 buttons there for true or for false, and then make sure you hit the submit button. And friendly tip, we have another polling question coming up pretty quickly early in the session. You do need 4 of the 5 to get the credit. So I'm going to give it just a few more seconds, and then we'll move on. It looks like we have about 82% that have responded. I'm going to move on in 3, 2, 1. Okay. And the answer is actually true. We have about 90% that said true. And On this slide here, I included the description from the NAIC Risk Alert. And obviously, we're all well aware of inflation and what's going on, in part because it's directly impacting our lives. The most recent data that I saw was that families are spending an additional $460 per month. But at this point, that actually feels low to me. So we'll see what they say next month. But while it's impacting our lives directly, it's also impacting insurance companies as well. And it's significant enough that the NAIC added it to their risk alert back in the fall. And it's critical that we as regulators consider the impact of inflation on insurance companies, as noted here in the guidance from the NAIC. And it goes on to specifically mention here that, increased claim costs and impacts on reserves and profitability, as well as some other potential impacts on investments. This was identified as an emerging risk in the fall, and in the spring edition that was just released last month in May, they actually moved inflation to the overall category as a risk that's impacting all insurance companies. So the NAIC, when they made that move to include it in the overall category, they also included some possible procedures that can be performed to address this risk. And I'll cover some of that in just a few moments. Okay, so here is our agenda for today. And that's really the goal, to highlight some specific examples of how inflation can negatively impact insurance companies and how we as regulators can assess that impact, evaluate management's plans to address the risk, and then determine if there are potentially any solvency concerns. So here's the topics we plan to cover today. First, Ed will provide a macro look at inflation and essentially describe how we got here. He'll also describe the impact on insurance companies' investments and the need to consider how management is responding with any changes to their investment strategies, and then what that would mean from a regulatory perspective and any additional risks that could arise. Then Dave will walk through some specific examples on the impact of on property casualty insurers, along with some possible analysis or tests that could be performed to assess the risk. And then Tricia will do the same thing for life insurance companies. And then I'll recap some of the procedures that regulators should be considering performing this year to address this risk. As it was noted, we'll try to save some time for questions, but please, by all means, if you have a question, type it up, submit it as we're going through the slides. We'll be monitoring all questions throughout, and if we have time, we'll certainly address them real time. And if we do run out of time, we'll follow up via email after this webinar. Okay, and now on to our second polling question. This is number 2 of 5. What is your current role? Examiner, analyst, actuary, or other? So again, just make your selection, select the circle there, and make sure you hit the submit button. Again, this is the second polling question of 5. So I'm just going to give it a few more seconds till we get, close to that 90% response range. We're at 85%. I'll just give it a few more seconds and then we'll move on. 3, 2, 1. Okay. And it looks like we have, kind of a well-rounded group here, which is great. We have a number of actuaries on the call. We have plenty of analysts, and about half the group are examiners. So with that, I am going to turn things over to Ed Toy.
Thanks, Bill. And as Bill said, I'm going to start first with just describing a little bit of where we are today, and then we'll move on and spend some time talking about what are the likely impacts of inflation on invested assets. I think the most important is to bring us up to date as far as where we are. The most recent headline that I could find that really pointed at this, and so therefore highlighted in red and in bold, is a Wall Street Journal headline that inflation hit 8.6% in May. That is a pretty significant number and is the highest number since December 1981. And this is a graphical representation of that data. So here we are. The blue line is for the overall CPI, Consumer Price Index number. The orange line is what they call the core number, which excludes two specific items that are considered very volatile and therefore not entirely indicative of what the real environment looks like. Now, of course, those two items that they exclude are energy and food, and we all know what's going on with energy prices right now as far as oil being up at somewhere between $100 and $115 a barrel. The last time the CPI numbers hit this kind of level was, again, back in the early 80s, when inflation was actually late 70s, early 80s, even higher than it is now. But you compare that to what those numbers have been since the inflation numbers came down in the mid-80s, and you see how much higher up we are. And again, you'll see that if you include the oil, the energy prices, and the food prices, that blue line has significantly greater volatility than the orange line. Thinking in terms of inflation and what is inflation and what generally causes inflation, the general economic reality is that inflation is caused by supply-demand imbalances. There's too much demand for goods and services. It is people who are looking for those goods and services drive up the price. They're prepared to pay more and more and more, and supply cannot keep up. So therefore, the providers of those goods and services push those prices up until the market clears. This particular situation that started at the end of last year, November, December last year, and really hit its high in the last 2 or 3 months, were primarily, or at least at the beginning, driven by supply chain issues. Many of those specific issues coming from the COVID-19 pandemic in 2020, difficulties in terms of shipments and getting raw materials and getting parts for different things, and that was the driver. And the thinking of many people is that the Fed initially was not prepared or was reluctant, or at least a little bit reluctant, to really dive in to try and drive the inflation numbers down with their monetary tools, because it was a little bit different. It was not the typical, supply-demand dynamic. And given that the Fed's tools, primarily through the FOMC, are very, very blunt instruments, they did not want to immediately jump into it, although by the end of last year, they were already talking about the likelihood of using their two primary monetary tools, which are the Fed funds target rate, which they have an ability to influence through reserving requirements, as well as their balance sheet. One more thing, just in terms of components of volatility that are more volatile, what is included in the core number, but was also very significant in the current inflationary environment, was rapidly rising housing prices, both rentals and housing costs in terms of purchases of new homes. Those things driven by people moving around, wanting to move out of metropolitan areas, given their population density, to more suburban or rural areas. That, of course, has already started to wind down fairly significantly as interest rates have gone up and mortgage rates have followed those interest rates. So also, just to give you an illustration, oil prices, the spike that we've seen when I took this graph, the West Texas Intermediate, which is the benchmark crude that I track, was up around $118 a barrel. It's back down to around 104, 105 right now. So you see how it's been bouncing around. The last time it was this high was back in 2007. Also, gas prices, which I think Bill might have alluded to. We're paying more than $5 a gallon now. But gasoline prices have never been that high. That's the highest they've ever been. Even if you go back to 1981, they were not that high. So that being your pocketbook item is pretty significant, and obviously Oil prices then also increase transportation prices. Transportation prices get factored into food prices. So even as the supply chain issue with food starts to diminish, now you've got the transportation costs of food driving, keeping prices high, if not continue to drive them up. Going back to what I was talking about as far as the Fed, again, the primary tool for impacting or trying to keep inflation, moderate, and the Fed's target has generally varied somewhere between 1.5% and 2%. The Federal Reserve Board has two primary tools in its toolbox as far as monetary policy. The Fed funds rate, which after three increases already this year, is at just shy of 1.6%. That compared to 1981, Fed funds rate was at 12%. So you kind of see, the Fed funds rate has been incredibly low. The Fed actually pushed that number down to zero in 2020 to keep the economy going, to try and keep things the economy from completely, totally crashing. Now they've been increasing. They have telegraphed that they expect to increase all 6 meetings this year. The first 2 increases were 50 basis points. The last one was 75. The general expectation for the July meeting, it's going to be 75 again, although to the extent that the core rate of inflation seems to be moderating a little bit, that might start to indicate that maybe a 50 basis point increase is going to be enough. But if you think about it again, if they do increase all 6 times, somewhere between 50 and 75 basis points, that means the Fed fund rates will be up around, they will have increased it by like 300 basis points for the year. And please keep that number in mind as I get through some of the later slides. Also, the balance sheet. To keep the economy going and to try and keep interest rates low, in particular, mortgage rates low, the Fed also in 2020 began a massive buying program using their balance sheet, buying up somewhere between $9 and $10 trillion worth of assets. A lot of them long-term assets, including assets that they typically, in past scenarios, did not buy. They typically just bought treasuries and government bonds. They bought municipal bonds. They bought RMBS. They bought everything they could possibly get, ballooning the balance sheet up to close to $10 trillion, which, again, compared with 2008, the great financial crisis, as we referred to it, the balance sheet of the Fed at that point only grew to $1.5 trillion. So you see the order of magnitude of what the Fed did with 2020, and now what they've got to do in terms of working with their monetary policy to get the inflation rate down. They have to be careful in terms of unwinding that balance sheet because they don't want to screw up the market. They don't want to dump bonds into the marketplace and drive bond prices down, which obviously has some pretty negative implications for investors. Now, to the extent that we think in terms of interest rates, I should have talked a little bit already about Treasury and then particularly the Fed funds rate, but that's not what insurance companies invest in. Insurance companies invest in some kind of risk asset. These are some numbers that I can get relatively easily from the Fed St. Louis website. And they are for single A's and triple B's, which we all think of as being for corporate bonds is the sweet spot for insurance companies, and also high yield or below investment grades. You see what's been happening since the end of last year. Single A's and triple B's have obviously been going up between 100 and 150 basis points. Below investment grade or high yield is up around 400 basis points. So as the Fed has been working its magic, so to speak, this is what's been happening to the marketplace and yields. And that's important to the extent that we start now taking our next step and thinking about, well, what does inflation do to insurance companies? And I'm obviously going to focus on the investment side. And I want to start out by saying that inflation itself does not have a direct impact on insurance company investments. There's no one-for-one for relationship. But to the extent that the Fed takes action and drives interest rates down, that has an impact on insurance company investments, and in particular corporate bonds and government bonds, which are fixed income instruments and represent somewhere around a half of most insurance companies' portfolios. So as interest rates rise, the value of what they hold will decline. Even so, on the good side is now they can invest in higher yields. On the bad side is the value of their existing holdings will drop. And I've got a graph later on that'll show you a little bit of that, but let me continue on with this list first. For structured securities, in many ways, those will react the same as corporate bonds and government bonds. As interest rates rise, the value will go down. But very significantly, there's an additional component there, and that is with residential mortgage-backed securities, or RMBS, because as interest rates rise, as mortgage rates rise, prepayments will drop off very substantially for RMBS. So that represents potentially a liquidity issue, because as cash was expected to come in based on prepayments, they won't come in. And I've got an illustration, a graphical illustration on that a little bit later. Mortgage loans, same as corporate bonds and government bonds. Equities, both real estate equities and common stock equities, that's a little bit of an odd situation, because long-term, an inflationary environment arguably is good for those two asset classes, because as companies are making more money, even though it's nominally more money, that number translates into a higher stock price. The ability of tenants will go up to pay on their leases, which will drive lease rates up and therefore drive the value of real estate, of properties up. But in the short term and possibly intermediate term, higher interest rates will have a negative impact on equities, real estate equities and common stock, because those asset classes, you also use the same discount rate, the interest rate, to discount back the value of those cash flows. And then investments reported on Schedule BA, about a half of unaffiliated investments that are reported on Schedule BA are somehow equity related, even though they might be private equity and private equity funds. But those obviously over the long term will act similarly to common stock. One last point as far as invested assets, and this ties a little bit to the comment I had just made about companies doing better, even though it might be on a nominal basis and not on an inflation-adjusted basis. That the reality is that also is likely to improve default rates, because lending is at the fixed coupon and their nominal revenues and operating income go up. So that's the overall impact, going very, very quickly, obviously, through insurance company assets. Again, the focus is on the impact of interest rates on investments, not inflation itself. A couple graphs that I promised to show you. This shows you very, very simple terms what happens as interest rates rise for short, intermediate, and long-term bonds. And looking at its extreme, the blue line is a 30-year bond that I modeled out a couple of years ago with relatively low coupons. If interest rates rise by 400 basis points, and that's the x-axis here, the fair market value of that bond drops by half, by 50%. And that's without any credit concerns. Nothing else happens. It is just straight out interest rates rise by 400 basis points. I obviously show across the x-axis here everything from 0 to 400, and will also tell you that interest rates since the end of 2020 are up 250 basis points. So a 30-year bond that an insurance company bought at the end of 2020, at the lowest point in interest rates, is now down probably somewhere around 35, 40 cents on the dollar. And that is purely, it's a U.S. Treasury. That's what's happened to it. Obviously, the impact is less on 10-year and 5-year bonds. The other thing to emphasize my point about the RMBS, typically RMBS securities are purchased with some kind of prepayment assumption. That's the constant prepayment rate, or a CPR. Let's assume that they made the assumption of a 5% CPR, constant prepayment rate, then a short bond that they thought would have somewhere around a 2.5-year average life is now a 6.6 year. And a long bond, which they thought had a slightly more than a 12-year average life, now has a 25-year average life. So the cash flows that an investor, an insurance company, thought they were going to get from a long bond, a long RMBS CMO, they're not going to be there. And that is something, again, to focus on from a liquidity standpoint. And that's where I get to, what do we need to focus on in terms of risks based on what I just said? The investment strategy, the investment portfolio, obviously a standard question is it appropriately structured to support the ongoing business? And to the extent that the strategy and the portfolio was constructed in 2019, 2020, when interest rates are low, now interest rates are a lot higher. And does that same strategy work? And what can the company do to the extent that that strategy doesn't work anymore? And the second bullet here, primarily from my standpoint, focusing on liquidity. You've got liquidity issues because of RMBS. You've also got liquidity issues because now the fair market value of bonds that they might be carrying at par is down at 80 cents on the dollar, 70 cents on the dollar. And even though it might be a liquid investment, do they really want to sell and take that mark-to-market hit? So those are my big points, and I'll pass it back over to Dave now.
Yes, indeed. Thanks, Ed. So we're going to talk now a little bit about what the impacts might be for property casualty insurers. And where Ed is talking about this from the investment side of the house, I'm going to talk about it for P&C insurers on the reserving side of the house. And we'll start off with the polling question. This is the third of 5. And the question is, which of the following lines of business do you think are most likely to be impacted by inflation? So we give you a few choices here. Auto, homeowners, workers' comp, all of the above. We probably could have had options E, F, G, so on and so forth, maybe for other lines of business, but we'll keep it with this for this question. And as always, make sure you submit your answer because you need to answer 4 out of these 5, and this is number 3. So we'll
Dave, maybe while we're waiting, can we sneak in one of the questions in the Q&A box?
Sure, if you'd like to ask the question.
Yeah, so Ed, I think this is for you. Do you have a thought on whether another driver of the inflationary environment might be the government stimulus, which kind of expanded the money supply? Any thoughts on that?
Well, I mean, that was certainly the what the Fed did in 2020 with their activity, what they did in both the Fed funds rate as well as the size of the balance sheet. That kept the economy from totally tanking. So the question is always, well, how quickly can they unwind that? That was a very, very accommodative policy to not have unemployment go up to 25% or for the economy, for the GDP to go even lower. So there are certainly some people who are saying they should have unwound it much more quickly. They should have been pushing the Fed funds rate back up starting the middle of last year and not waiting until the first meeting this year. They should have started unwinding that $10 trillion balance sheet way longer, and maybe not even have increased it, the balance sheet to that $10 trillion number. But I think that's all hindsight. And I personally not being an economist, don't think they did the wrong thing. I mean, I think they waited for the reasons that I outlined before, that this round is different. It's not the same as other inflationary environments. And I think they're on track to do the right thing here.
Thanks.
Thank you, Ed. And I would say that gave everyone sufficient time to answer. So let's see what we've got here. We've got a whole lot of all of the aboves. I can't say I'm shocked by that. I would tend to agree. In the environment that we're in, probably pretty much any line of business you can think of is probably going to be impacted by inflation. So when we're talking about reserving risk, the question that we want to talk about today is, does being in this elevated period of inflation translate to elevated reserving risk for P&C insurers? Intuitively, you might think yes. But we want to talk about how you might look at that. How might you test it? So some of the questions you might ask is, well, from an overall CPI perspective, that's a number that gets quoted all the time. We always kind of see what it is month by month. We know it's very, very high right now. How useful is that overall number for trying to assess what kind of level of reserving risk we might have now for the P&C industry relative to the past? And then a second question is, well, are there other ways we might get at this? Like, are there components of the CPI that might be helpful in answering that same question? And how would you go about looking at it in the first place? So I'm returning now to a picture you saw earlier in the presentation that Ed showed. And this is overall CPI. And, what the takeaways are, I would say, from this slide, and we'll talk about it also on the next one, is that, we're sitting here on the far right. You see elevated levels of inflation. We all know that's what we're in. As you look over to the left, what you see is that we haven't seen anything like that since way back when, and it's probably very, very hard for you to see the numbers over there. But those years, we're talking about late 70s, early 1980s. So why is that relevant? It is relevant in answering that first question as to how useful is the overall CPI for assessing what level of reserve risk we might be facing right now as a P&C industry. The reason is this. From 1992 to 2020, it never got higher than 5 to 6%. By it, I mean the overall CPI. And when you talk about data that we have at our disposal to look at and kind of track what reserve risk, how much reserve risk was there historically, it's pretty hard to go back earlier than 1992. You can actually get some years prior to 1992, but in terms, I always think of Schedule P as the way to go about doing this when it comes to accessing publicly available information, looking over a broad selection of companies, and so forth. And so, the point that you can take away from the slide is that we can only go back so far and do that with Schedule P data. And the history we have for the Schedule P data does not encompass very, very, very high periods of inflation like we have right now. So therefore, the overall CPI, I think, is probably of limited utility in trying to answer this question of just how much reserve risk is there right now. So now we can talk about components of the CPI. And so I'm going to use an example that is one of many, dozens, I would say, that you could pull from different components of the CPI. This one may have an intuitive relationship to auto reserve risk. And the particular component of the CPI is motor vehicle parts and equipment. And what you have here is your blue line is that component of the CPI. The red line is more the overall CPI. And what the picture is showing you over a more contracted history than we were looking at before is what you would expect. Anytime you look at a piece rather than the whole, you should have more volatility. And so you do see more volatility in the blue line. And from my point of view, that is a good thing in trying to find something that might be useful in answering this question of how much reserve risk is there now, because at least we can find things that maybe what got closer in the past and the recent past to where we are today. Okay, and so this slide basically repeats all the points that I just made. It's easier to talk about them when you have a picture to look at it. And so the only point that I will focus on from this slide is there at the bottom, which is this is one example which may have a relationship to auto insurance. There are probably many others that could have a relationship to auto insurance. And there are others beyond that that could have a relationship to homeowners and workers' comp and medical professional and so on. So where I'm leading up to here is trying to give everyone an idea of just a framework that we could use to test this theory. Does higher inflation seem to have a strong relationship with higher reserve risk? And as I said earlier, Schedule P, an actuary, I love Schedule P, I can't help myself. Schedule P Part 2 is a great place to find information on historical reserving risk. It is the report card for how management did in terms of estimating losses out of the gate at 12 months and then over time. And so let's talk about how we might use Schedule P to do this and to set up this framework. So what I'm showing here on this chart is actual results over a 16-year period for a particular insurer. It is an insurer that happens to write non-standard auto insurance. And for each year, you see we have years going across the bottom from 2005 to 2020. For each year, we're showing you where the company started off for that particular year. By the way, year is an accident year in this context. So look at the far left, the orange bar, 2005, started off at a 65% loss ratio. Hopefully you can see that. And then the blue bar right next to it is where that accident year ultimately ended up. So great news for 2005. It started off at a 65% loss ratio. It ended up somewhere around 55 or so. There was favorable development. Management overestimated out of the gate, and there was favorable development subsequent to that. You see a similar story for 2006, 2007, and then 2008, the story starts to change. We see blue bars starting to get higher than orange bars. Then we start to see blue bars getting much, much, much higher than orange bars. This is bad news. This is not the kind of thing you want to see. This is what I would say is an example of reserve risk. Displayed graphically, this company had a lot of adverse reserve development, especially for 2011 to 2016 years. And then something seemed to happen. I'm now on the far right of the chart, and you start to see orange bars bigger than blue bars again. So things maybe have stabilized. But just so that's how you think about this chart. This is kind of the report card that I was referring to earlier. And so this is another piece of the puzzle, right? So one piece is what's going on with inflation. The second piece is what's going on with reserve estimates. Okay, so now let's talk about how we might be able to put those two things together. And that's what this chart is doing. So first, let me talk about what you see here in terms of the orange bars. What these are is just consolidating the two things that you saw on the last chart. So simply taking the difference of where management started versus where management ended up. If there's favorable development, remember the 2005 example, we started at a 65, we ended up at a 55. That's 10 points of favorable development. That's why you see an orange bar of minus 10 in 2005. And as you go across, you see what we talked about before, favorable development for the earlier years, adverse development, especially in 2011 to 2016, and then stabilizing subsequent to 2016. So that's what orange bars are telling you here. The blue line, what we've done is we've superimposed that chart we showed earlier from the CPI, so the motor vehicle parts inflation. So the question is, does the adverse reserve development we see with this company seem to correspond with higher periods of inflation for this particular chart? And I would say not so much. And you would probably say, looking at this, not so much. It actually looks like lower periods of inflation seem to have corresponded with the poorer activity. So that's okay. This is one company. We don't think we're going to have the answers to the world from looking at one non-standard auto writer. The main thing that we wanted to do by showing you this is just give you a way of thinking about how might you test the theory in the first place. And you can have lots of different ways of adjusting this and looking at it in similar ways. So one of those might be, what happens if you lag inflation? What if it doesn't hit insurers right away? Like high inflation maybe doesn't translate to missing reserves by a lot right away. It's hard to know. Maybe it takes a few years. This is what happens if we lag that chart, the inflation chart, by 3 years. Actually, by happenstance, higher periods of inflation, in this case, when we lag it, actually do seem to correspond to higher periods of adverse reserve development. And I'm not going to tell you that, therefore, we've solved it. Again, it's one company, but just to show you that there are multiple ways of looking at it in that manner. So what else could we do? We could look at not just 1 year indices and inflation as of this year and that year and the other. We could maybe look at a composite inflation index over a longer period of time. Another thing we might do is consider not just each accident year in isolation, but maybe a composite or an aggregation of accident years. And one way you could do that is by looking at what's coming through for the 1 year reserve development test that everyone sees in the 5-year history for P&C insurers. An advantage of that is that it might help you pull in and think about calendar year effects of inflation, because what I've shown you so far is only accident year effects. And so calendar year effects are probably pretty important too. So this is one way to do that. And I'm sure there are other ways as well. But we will leave it at that for now. Just a reminder that this was just an illustration, one company, no major conclusions can be drawn from that. But hopefully the framework is something that can be used. And I think it can be. And there's a lot more to come on this. And with that, I will pass it over to Tricia to talk about this from the life and health side.
Thanks, Dave. So I'm going to talk a little bit about considerations for life insurers, and I'll be sprinkling in some health insurance considerations in there as well. So this slide talks about both direct impacts from inflation alone, as well as some contagion impacts. In other words, impacts that you might have because of inflation, but are not directly due to inflation. And then probably obvious, the green is things that tend to be helpful for the insurer. Red are things that hurt the insurer. So the immediate item that you see for a life insurer, or honestly any insurer, is increase in costs because of inflation. So that's happening already and will continue to happen. For certain insurers, you could potentially also see in the short term an increase in reserves. And the reason for this is that for life insurers that are doing asset adequacy testing, we're coming off a period where a lot of those companies had to hold additional reserves. In other words, their booked reserves were not adequate, and cash flow testing showed that they needed more. And one of the assumptions in cash flow testing is inflation. So if that assumption goes up and they're already without margin, they have to hold more reserves, they may have to hold even more. Now, again, I'm focused on inflation only because we do have some offset in other places, and I'm going to talk about that. We could see, because of those items, liquidity shortfall. So if a company doesn't have a big liquidity cushion and all of a sudden things that they have to pay for are much more expensive, we could see liquidity issues. And then on the benefit side, although of course it's going to take time to weave its way into their balance sheet and their income statement, companies will be increasing their prices. Exactly when, will depend on the individual company, but inflation will certainly drive that. I think more interesting, and Ed alluded to this as well, is some of the contagion impacts, most notable rising interest rates. So in addition to the impacts that Ed talked about, where we may have depreciation in asset market values, sometimes very significant, that could be combined with a very significant impact on policyholder behavior. And in particular, if rates rise fast. So Ed talked about the multiple actions that the Fed will take. And if rates are going up quickly, for companies with books of business that are very interest sensitive, like deferred annuities, their policyholders will look to get a higher rate on their money elsewhere. And so they may see a lot of outflow of their customers all at once. And then again, there's some positive here. And this is an important one. In the green, we have potentially higher returns on the assets. And then that can translate, of course, into higher spreads on the products. In other words, they earn more than they have to credit to the policyholder. And I know a lot of life insurers are looking forward to that. The last quick thing I'll mention here on the health side is I've participated in some interesting interviews with health insurer executives where they may have strategies that to mitigate the potential for increasing costs, and in particular, provider contracts. So those may have locked in prices, even if the cost of providing care has gone up. The insurer may be insulated from that. But I think something that they have to be very careful about is the fact that I think it's very common for providers to be offsetting, and I'm not saying this is necessarily deliberate, but offsetting their higher costs with higher utilization, kind of encouraging utilization, maybe shifting to higher cost codes. And so even if the health insurer has kind of protection via contractual rates with providers, I think they do have to be careful about utilization. So we have another polling question here. Which Lifeline of business is most likely to be impacted by inflation? And I'll let folks have a few minutes here, and I'm going to read one more of the questions that's come in. And Ed, this is for you as well. Oil pricing was pretty stable on your chart until the 2000s, and then it seemed to get more volatile. Do you have any perspective on what drove that?
I think a lot of that additional volatility was because the futures market, really ballooned in size, and there were a lot of hedge funds, playing that game and playing commodity prices. Now, I wouldn't say that's all of it, but I think that's a significant part of it.
Thank you. Super interesting. All right, so just another reminder to folks, I hate to get in the way of someone's CE, so complete your polling question. We're going to close it in a second here. I see we've got most of our folks have responded, but definitely get that polling question answer in. And we'll go now with 5, 4, 3, 2, 1. Okay, and similar to Dave, we have a lot of all of the aboves, but I do also agree that I think we're going to see more impacts with some of the interest-sensitive products. So that does not surprise me either. So I have a few examples here. I'm going to try to move quickly in the interest of time. So this first page is a simple look at what could happen to the income statement of a life insurer only under a rise in inflation. So no change in interest rates. We know that's not where we're at. So again, I'll make this one pretty snappy here. So revenue goes up slowly. It's going to depend on, bringing in that new premium that may be at a higher rate. Expenses rise immediately, so they take a hit on the expenses. That's the brown line. And then I mentioned before that the change in inflation could drive an increase in reserves. It depends on a number of things, but that's why you see operating income dropping when we see the expenses go up and there's a one-time spike in the reserve because of that change in the inflation assumption. And then that would actually potentially look even worse if we were talking about something like long-term care, since benefit costs could also spike. That will depend on how the benefits are provided. If they're fixed benefits, we wouldn't have that phenomenon. But for benefits that are subject to inflation, we might see a worse event. And then I've included here at the bottom a few things that we might want to ask the company to understand better what their exposure is. Are they increasing their premiums? Are they updating those inflation assumptions? Do they already have margins and reserves, or are they kind of at the bare minimums? So those would be important things to understand. This slide comes from the report that FIO put out in May. and it has a couple of metrics. I know there's a lot going on in those pictures, so I'm just going to give a 10,000-foot view, but definitely encourage folks to take a look at the report that they issued. And basically what this is saying, the top graph is saying life insurers, and actually P&C as well, life insurers are holding more illiquid assets in general. And part of that was driven by the low interest rate environment because insurers are searching for yield. The bottom chart is showing that on top of that, life insurers on average have more non-traditional liabilities that could have more like demand deposit payouts. So need for liquidity. So we have less liquid assets and potentially more liquid, in other words, people walk away, type liabilities. And I'll leave it at that again in the interest of time. But that kind of leads us to my example number 2. So this example, probably a little bit more of a realistic one where we're sitting today, is we have the inflation spike and we have a very fast increase in rates. And so here, instead of showing an income statement, we're focused on liquidity. In other words, cash inflow and cash outflow. Similar to the prior example, the inflows don't change much because, again, they will, like little by little, we'll earn a higher return, we'll have higher premium, but that takes time to be true because I have to have my investments mature, I have to change my prices. Again, the expenses are up immediately. And on top of that, because rates have spiked, we have a big increase in surrender benefits as well. And the result of that is a cash shortfall. That could be even worse if the company has a lot of these illiquid assets. Because if there's a lot of liquidity, cash on hand, that cash flow can be covered. But if there's a need to liquidate illiquid assets at a significant loss, it's kind of a double whammy for the company. So that's an important risk to look at. It is a risk that should be tested by life insurers in their asset adequacy testing. It depends on how good of a job they do, but there is data there that gets submitted every year that would look at a scenario like this one. And then just a couple of considerations we might have in this example. To what extent do they have illiquid assets or non-traditional liabilities? Is there a lot of business that's exposed to this disintermediation risk? And that would be business where there's a specified guaranteed interest rate. And, in the low interest rate environment, that was probably a really good deal. It might have been 3%, which was hard to come by. If rates go up dramatically, that 3% guarantee policyholder can go get 5. So they're probably going to do it. And then do they have cash available or very, very liquid assets that don't have a depressed market value? And then that last point is like, to what extent would they have to sell assets at a significant loss? Do they have a lot of market value less than book value on their balance sheet already? And then just the last slide I have here is some things that the company might do to mitigate these risks, looking at my 2 scenarios. And again, I think it makes sense here to focus on the second one. They might be increasing their credited rates to try to hang on to some of those customers. They might be moving a little bit more money into cash to combat the need to sell assets if there is disintermediation. And then most companies have contingent sources of liquidity. So things they can access, commercial paper, Federal Home Loan Bank. So is that available, and do they have a kind of a process in place to do that? And so maybe with that, just because I want to make sure Bill has some time here, I'll move us on to the next section.
Okay, thanks, Tricia. And I'm going to briefly cover implications for regulators. But first and most importantly, our 5th and final polling question. Have you observed any insurance companies that have already been impacted by inflation? Yes, no, or not sure. And I know we do just have 5 minutes left, so I'll give just a few seconds here. I know we have a few questions that came through, and they're great questions. So we'll certainly follow up after this webinar, and we'll respond via email. One question I really like, and it's most of the questions, of course, are for Ed. Are you seeing a lot of insurers recently selling their low interest bonds at a loss to purchase higher interest rate bonds? And Ed, I don't want to put you on the spot because we only have 5 minutes left, but I think that's something that we'll likely see. but just wanted to mention that. So, okay, we're at 89%, and I don't know if you have a quick comment on that one.
Yeah, the quick answer is there's always some selling, some repositioning when there's market volatility, which we're clearly seeing now. But I haven't seen much that would be significantly, companies are dumping portfolios. It's a little here, a little there, especially of shorter durations.
Thanks, Ed. I'm going to close the polling question now. So if everyone can submit their response, it looks like we're well over 90%. We have about 46% that said that, they have seen that already. And, and it's funny. First I'll just mention possible procedures. These are straight from the NAIC Solvency Monitoring Risk Alert from the spring 2022. And the first one here, gain an understanding of and evaluate the impact of inflation on loss costs for insurers' top lines of business. While we've been presenting, I actually received an alert from S&P that they have a new study out. And I just quickly saw the article. It's a fairly in-depth article with really good charts. And they're projecting that for 2022, for the P&C industry, the overall combined ratio will go up about 1 percentage point and actually put them over 100%. So, obviously we continue to see the impact. So certainly want to gain an understanding and evaluate that impact. And I think, where we're seeing it, maybe the most is with, auto insurers. And we've been seeing that for some time now, going back, well over a year at this point. So again, these procedures are straight from the NAIC, which is great. And, in addition to this guidance, I would just also mention that, as part of a financial exam, include the risk or multiple risks on your risk matrices. That basically forces you to go through the process, through the 7 phases, and fully evaluate that risk. And, once it's on a matrix, you can gain an understanding of management's approach, the processes and controls that they have in place to manage that risk. And you can inquire with management, regarding the actual impact to date, put the onus on them to show you how inflation is impacting their company. And then also you can also inquire, about any, analysis or projections that they've done on the prospective impact of inflation on the company. For the larger companies, a lot of this should be laid out in the ORSA, so that could be a great resource for the larger companies. And then just utilize examiner judgment to assess if the company's assumptions are appropriate for their lines of business and for what we're seeing, in the external environment. Then obviously you would, execute testing to validate management's controls, assess the effectiveness of those controls, perform any substantive procedures. That's where, I think you'd want to pull in your specialists, your actuaries, your ed toys, if you have access to an investment specialist. And then, evaluate surplus levels to assess the company's ability to absorb any financial impact. And then, document the risk assessment level and the trend and communicate any findings to the analyst. And if there are any issues or any gaps as far as, management's ability to address this risk, you may have some findings and recommendations, but it's something that the department needs to, coordinate on and ensure that everyone understands the impact for each of the insurance companies. So that I'm going to move on, quickly run through the summary. Just the key takeaways for today. Inflation is potentially a very significant risk that we need to evaluate as part of the ongoing regulation. Analysts, examiners, we all need to be thinking about this. Pull in a specialist where appropriate, make sure the impact's understood, and then make recommendations as necessary. So we have about a minute left, and I am going to turn things over to Allison.
Thank you. A few reminders before we conclude. Please take a moment to complete the attendee survey by following the link in the resource list to the right of your screen. We will respond to all questions via email following today's event. We appreciate you joining us and thank you for participating in today's program.